Yeah, we understand that the decision between having capital and not having capital to get started really depends on if you're going to take private money or if you're going to JV partner. Run the numbers with your JV partner. Understand that it might take a year or two or maybe even 3 to be able to take on that equity position and get a return on your investment.
Private financing or joint venture partners? This is a question that every real estate investor is faced with on every single transaction. But for a lot of new real estate investors, it's a very intimidating subject matter. Should you be selling debt or selling equity? Because that's really what we're talking about when we're talking about financing privately, or we're talking about bringing on JV partners. And also, the two don't have to be mutually exclusive, but in today's video, Josh and Ehren from the Findlay Mortgage team are going to break down for us exactly what you can expect in regards to doing that JV or doing that private lending.
Hey guys, one of the questions that we had proposed to us was, is it better to start out as a joint venture type partnership or using private funds to get started on the venture? So what we wanted to do is just give you a quick little breakdown of one scenario with a private versus a potential joint venture partnership. Now, I mean, we know there's a number of different ways you can structure a joint venture. This is one option, but the idea is just to give you guys a sense of the potential timeline that it can take to get your initial investment back on the joint venture versus what the equity position in your property is going to be after 1 year in a private mortgage. So like I said, there's obviously some other ways you can structure. If you guys have other structures and questions that you want to run by us that are different than this, obviously feel free to reach out, but we'll go over this and then we can touch base later. So just a breakdown of our example quick. So we're using a purchase price of $350,000. Your down payment at 20% there is going to be a $70,000 down payment, and then your mortgage amount is going to be $280,000. And we're doing this on the B side. This isn't going to be an A side funding, so there are going to be some fees and stuff. On the private side, we're going to have our 2% broker and 2% lender fee. So that's $5,600 each. Legal fees, so you are responsible for both your own and the lender's legal fees. So we estimate around $3,000. The appraisal, we're using $300. It's going to be usually around $300, $350 for the appraisal. The renovations that we're using for this example, we're using $30,000. Obviously, that can depend on the project. And then your monthly interest payment on the private is going to be $2,333.33.
And so on the other side, the joint venture side, say you guys go and do an unconventional application and we get you in with a B bank. Well, there are still fees associated with the B bank, but they're not as much as a private loan. So the B bank is going to charge a 1% lender fee and a 1% broker fee. They're going to be $2,800 each. A legal fee of $1,850. So because you're only paying for your legal fee and it's not a private mortgage, it's not going to be that $3,000 that we had spoken about here. The appraisal, we're going to use a nominal number of around $300. The renos are going to be the same across the board because it's the same purchase price and the same down payment. But your monthly payment is actually $1,191.13, and that's a principal and interest payment.
So your ARV, after your 1 year, we're going to go the full 12-month term. Let's say that's coming out at $450,000. Now, because this is only an interest payment, you're not paying anything towards your principal, so your balance is still that same $280 that you took out at the beginning of the year. 75% on the refinance of rental properties right now, loan to value wise, that comes in at $337,500. And then if we take a look at what your new mortgage is going to be on the refi and what your balance is you have left owing, your equity position is $57,500. So that $57,500, that's going right into your pocket. Now, obviously, you can take a look at potentially pulling out, deducting the renovation fees from the beginning. You are going to be going into a refinance, probably on a B side. So you are going to have, your 1% lender, broker, your legal, maybe you're going to have your appraisal as well to determine the value. But this is what you're going to have after that, after that refinance going into your pocket.
It's the same thing for the joint venture side. We have our ARV of $450. You did some renovations. You put your $30,000 into it, raised the value, force appreciated it, $450. The balance is $274, $222. That's because you actually were paying principal and interest payments. So the principal amount of the loan actually decreased the entire year that you were paying it down. The equity that you have is $63,278. Now, because you're a joint venture and you've signed some documents together, you guys are 50-50 partners, meaning the equity that's left in the property, you each are going to split 50-50, if that's how you structured it. We specifically structured it for numbers' sake that way. Currently, you know, the equity you have left is $63,278. You divide that by 2, because there's 2 of you, it's $31,639. And as you can see, it does not get the initial investment back right away. So you would have to take a little bit longer to be able to recoup that investment.
What happens if you structured it as a 50-50 equity share with a 7% cash on cash? So the initial equity or the initial investment from the joint venture was half of the down payment. So we were using $35,000. So at this position, if you were to look at 7% cash on your money through that first year, you're looking at a return of $2,450. So again, even if you do make your initial investment back, you add on your 7% cash after the year, you're still only looking at that return of $37,450. So, you know, still probably not super enticing to either, you know, as a joint venture, as the potential partner coming on, or as someone who's holding onto the mortgage in terms of splitting the equity, not super enticing. The last option that we can take a look at here, just to show you guys what some of the numbers look like, is, you know, a 2-year buy and hold. You did do the renovation, but let's hold on to the property a little bit and get that appreciation. And then we're still going to go with 7% cash on cash. So we're using a 7% on average property appreciation. So let's say your new property value is now $481,500 after that first year. And then the 7% on top of that second year. The balance remaining, because you've been paying that down, it's principal and interest, you're going to have $268,818, 75% loan to value on that $481,500. That gives you $361,125. With the equity position now, you now have $92,307 in equity. So again, we're going to split that in half for that 50-50 share. Gives you $46,153. 7% on that $35,000 initial investment for the 2 years. It's going to give you $4,900. You take that $4,900, you add that to your $46,153. It's going to give you a return $51,053. So a much more enticing return for a potential JV partner. You know, and again, the idea of this is just to give you guys a sense as to how long a potential JV partnership can take for you to really start getting a return on your investment and or on your equity position if you are looking to sell employer equity out and pay out your partner. So for those of you that are looking to get into the real estate investing, we have a couple different options in front of you. If you're looking to get into private mortgages, that initial return can be a lot more direct and in a shortened time period. Whereas if you're looking to do some sort of JV partnership, as you can see, potentially it can take you a little bit longer to actually get some return on your investment.
Yeah, we understand that the decision between, you know, having capital and not having capital to get started really depends on if you're going to take private money or if you're going to JV partner. You know, it does take a little bit of time, so defining that exit strategy, as we always say, making sure you know exactly what that looks like. Run the numbers with your JV partner. Understand that it might take a year or 2 or maybe even 3 to be able to take on that equity position and get a return on your investment. It may be growing, but 50% of it is somebody else's. So being able to access that liquidity and needing it at an expected time frame that your investment strategy allows you to is going to be super important. You know, private money, it's expensive up front, but as you can see, if you have the down payment, it is a viable option, specifically because if you force appreciate an asset, it allows you to use it as a tool to be able to help you to move forward with the next project. So all different alternatives to consider. We highly recommend, if you are going to do either or, feel free to reach out to us. We'd be happy to answer any questions you may have, and we can run the numbers. These are obviously hypothetical, but if you do have solid numbers, we can run those for you and help you out.
And the biggest thing to kind of consider too is it really comes down to what your upfront capital is. As Josh said, there are a lot of expensive fees associated with the private side, and you are most likely going to be, you know, in this scenario, we had you coming up with the own renovation and the full down payment. So again, you're going to be required to have that upfront capital. If you're new into the investing field and maybe you don't have the capital, Maybe you're someone who can hold a mortgage, but you don't have the cost for renovations or for the down payment. Bringing on a JV partner can be a good way to get going. So going back to that kind of initial question of which is the best way to start out and to grow your business, a lot of it's going to depend on what your initial capital situation is up front. Do you have the capital to carry the cost of a private with the renovations, the down payment, or are you going to be looking at some sort of joint venture partnership to come on and provide funds for you for the down payment and or the renovations?
Thanks again to Josh and Ehren for shooting this video, because I know it's a subject matter that a lot of real estate investors have questions on in regards to, well, should I do a JV? Should I do private lending? I'm not really sure how to make sure I can do this deal. So I hope you guys got some perspective in today's video. But if you've got more questions on it, jump in that comment section down below and we'll make sure we hit it on future videos.